Welcome back. Now, uncertainty may not be good for markets, but it does provide potential upside for gold due to its safe haven appeal. According to the World Gold Council's first quarter gold demand trends report, despite the record high bullion price environment, total demand for the yellow metal edged up by 1% year on year, with investment demand now at its highest level since the first quarter of 2016, boosted by the revival of gold ETF demand. John Reade, Chief Market Strategist at the World Gold Council, joins us to unpack the first quarter gold demand trends in greater detail. John, thanks so much for your time this afternoon. And let's start there, with the demand dynamics, considering that, we are in an uncertain environment and we are seeing, the prices of gold hit record highs.
Sure. I mean, we saw 20 new all-time highs for the US dollar gold price in the first quarter, and we've seen another 5 in April already. So this risk and uncertainty is encouraging investors to add to their positions and is driving gold higher at the moment. That's really the bottom line story from the first quarter of gold demand trends.
And we saw that investment demand really being fueled by ETFs this quarter, another result of the current economic environment, considering that equities are under pressure. And, we're seeing that move into safe havens.
No, very much so. And the ETF story turned positive around about the middle of last year, but it's really come to its fore in the first quarter of this year and has continued with strength into April. One of the big themes that we've seen within the ETF world, though, is increasing interest from Chinese domiciled ETFs to buy gold. That's been a really big theme in the first quarter and has only strengthened further in April.
And talk to me about those dynamics, what we're seeing when it comes to buying from Chinese investors versus Western investors.
Sure, because I think it's a really important point here, is that if you think about the strength that we've seen in gold over the last 2 or 3 years, this hasn't really been driven by Western investors. And in fact, they've been reducing their holdings of gold via exchange traded funds until the middle of last year. In terms of bar and coin demand as well, so physical purchases of Krugerrands and other investment gold, again, we've seen weakness coming through from Western investors, but tremendous strength from emerging markets. So that's one of the things I found most interesting about studying the gold market in the last couple of years, is how Western investors haven't really been that interested. I guess with the strength of the US equity market, at least until the end of last year, perhaps you could make a case for saying you didn't need to have gold. But now that we're starting to see asset markets under pressure in the West, I suspect this might be the catalyst to bring investors back to gold in the United States and in Europe.
And that's what I was about to ask you, whether these Western investors are seeing elsewhere, even if it's not equity markets, perhaps other safe haven assets?
I don't know. I mean, we haven't really noted any switching from gold into anything else. I think it's been, in the case of Europe, profit taking. If you think investors bought a lot of gold after the COVID pandemic, and the price has done really well. And I suppose the other alternative now is that you can sell your gold and you can invest those proceeds in the bank and get an interest rate, something we really haven't seen in Europe since the global financial crisis. That's probably playing a bit of a role in the US as well. So we certainly expect interest rate cuts as they come through should help Western demand. But I think in the case of the United States, people need to become more concerned than they are at the moment. It would seem that investors are looking for the opportunity to buy the dip in equities and other asset markets rather than actually factoring in more broader concerns. And if the US economy slows, as it seems to be, or even tips into a recession, which some people are calling for, then potentially we could see investment flows in the United States and probably Europe really add to the strength that we've seen in the rest of the world.
And John, talk to me about what's playing out when it comes to central bank buying. I see that it's still robust, but we are seeing declines in demand in the first quarter.
Sure. And look, the fact that we're not talking about central bank demand as the most important thing in the gold market just shows how much we have become used to strong central bank demand over the last 3 years. In each of the last 3 years, central banks bought just over 1,000 tons of gold. In the first quarter, they bought something in the region of 240 tons. I can't remember the exact figure off the top of my head. It's in line. And it's no longer big news because we've become so used to central banks buying so much. And I think if risk and uncertainty is playing out in asset markets and encouraging investors to buy gold, I think central banks will be paying attention to what's happening as well, particularly with the pronouncements coming out of the White House and the administration that must be making some holders of dollar assets, particularly long-term holders of dollar assets, pretty concerned and arguably more concerned than they were over the past couple of years.
Especially as we've seen, pressure on the dollar as well over the past few months. Now, it's also interesting to see what's been playing out on the jewelry side. In terms of purchases, consumer demand for gold jewelry, there was growth in all markets except China. I guess we can put that to the fact that consumption in the country is downbeat. But then it's also interesting to see how, the Chinese investors are putting their money in ETFs as well as bars and gold.
Absolutely. And I think, look, it is no surprise that when the gold price goes up like it has, that we see a decline in jewelry demand. And it's something we noted last quarter as well. So, that's how the market balances itself. It's a long way away from London to down to South Africa. So, look, jewelry demand weaker with high gold prices, exactly what you would expect. And to be honest, that's how the market balances. We have supply, which is pretty steady, and strong investment demand. So the only thing that can give really is jewelry demand. Investors drive the price up so that jewelry buyers buy less. I mean, it's an entirely normal performance of the gold market and nothing to be concerned about. The value that people were buying of jewelry during the quarter was up strongly year on year. So the jewelry market's fine. It's just gold is more expensive.
Before I let you go, John, is the flatlining in tech demand something to worry about? Walk me through what's going on there. Are we perhaps seeing less take-up or investment in the sector, perhaps as we wait for more certainty when it comes to the global economic picture?
Yeah, I'd hate to be a supply chain analyst at the moment trying to work out what producers are doing with anything. And I think technology is getting affected by this too. We know that gold continues to be used in high-end electronic components. And we know that those components in a normal economy would be growing strongly because of AI demand. I do think the uncertainty that's coming through from the US and a bit of a global economic slowdown that was in place already is probably playing a role there. So nothing to be concerned about. Technology demand is a small but important component of overall gold demand. And, you use gold because you have to, not because you want to. So this is going to continue.
John, thanks so much for joining us and just taking us through the trends playing out in the gold market. That was Chief Market Strategist at the World Gold Council, John Reade.